In this video, I'm going to look at the investment case for UK stocks. Investing in the FTSE 100, the index that tracks the performance of the 100 largest companies on the London Stock Exchange, has offered pretty underwhelming returns for a long time now, with a performance chart showing a return of only 8.99% over the past 5 years. This does not include dividends, but even so, it is certainly very underwhelming when we compare it to the more popular US stock index, the S&P 500, which has seen gains of a massive 79.12% over the past 5 years. And more recently, in 2023 alone, the S&P 500 saw gains of 24.23%, which is an incredible performance. Meanwhile, the FTSE 100 only saw comparatively very small gains of 3.78%. So if your portfolio was more tilted towards UK stocks than the US in 2023, you're probably kicking yourself now and considering going all in on US stocks this year. Whilst that certainly is tempting, I don't think UK stocks should be completely written off, and they do have some things going for them. I previously went through this topic in September last year in my video UK Stocks Are Cheap, but I think with the start of the new year and some recent positive inflation data, it's now a good time to revisit the question of, should you buy UK stocks? To answer this question, I'll look at the valuation of UK stocks to see if they still look cheap, then I'll look at the sector breakdown of the FTSE 100 and state what I think that means. I'll also look at dividend yields, given that dividends are one of the main reasons people like UK stocks. And finally, of relevance, I'll look at the impact of inflation and interest rate announcements in recent months. Throughout the video, I'll make comparisons to the S&P 500, which should also help highlight some of the reasons why the FTSE 100 has offered such poor returns. By going through all these things, I hope to help you make your own decision as to whether you should buy UK stocks in 2024. At the end of the video, I'll also share the exact way that I would invest in UK stocks. Before I begin, always remember these videos are not financial advice or a recommendation to buy any stocks featured. They are for educational and entertainment purposes. When investing, your capital is at risk and you may get back less than what you put in. So to establish whether UK stocks can be considered cheap, I'm going to look at the forward price to earnings ratio of the UK stock market. Forward price to earnings is the share price divided by forecast earnings per share. This is considered a better metric to look at than trailing price to earnings because it is forward looking and goes off expectations of what companies will earn. And a key thing you need to remember about the stock market is that stocks are priced based on expectations. So it does make more sense to look at the forward ratio. Oversimplifying it, a high forward PE ratio can mean stocks are expensive, whereas a low forward PE ratio could indicate they are cheap. With that in mind, I'll now turn to this chart from Yardeni Research, which shows the forward PE ratio of MSCI UK. MSCI UK is another index that, although is a bit different to the FTSE 100, it is very similar, so you can take the forward PE of MSCI UK to be a very good indication of the valuation of UK stocks as a whole. And looking at this chart, we can see that the current forward PE ratio, as of the 12th of January, is 10.7. Now that might not mean a lot to you, and indeed that number is pretty useless on its own. But here comes why this chart is so useful. We can see where this forward price to earnings ratio sits in relation to how it has been historically. And it is clear that overall, UK stocks are certainly looking very cheap from a forward price to earnings perspective. With the exception of September 2022 when a certain infamous mini budget was announced, UK stocks have not been this cheap since the brief COVID dip in 2020. And before that, the forward PE has not been this low since 2013. So yes, compared to recent history and beyond that, UK stocks are looking very cheap. But how does this compare to valuations over in the US, for example? Well, the S&P 500 currently has a forward PE of 19.6, and certainly in absolute terms, that is almost double the forward PE of the UK stock market. But you can't just compare the US and the UK like this because there are so many differences, including some I'll discuss in more detail later in this video. However, what we can do is look how the S&P 500 sits in relation to its own historic average. And if we take out the 2020 to 2021 period when valuations went crazy, we can see the opposite is the case for the S&P 500. It is looking more expensive than it typically has been historically. So with that information, shall we all go rushing out and sell our expensive US stocks and go grab ourselves some UK stock bargains? Well, clearly it's not as simple as looking at a chart like this. Otherwise everyone would be doing that already. Stocks are cheap or expensive for a reason. And the way I like to think about it is that if a forward PE ratio is high, it means that there is a lot of optimism and investors expect a lot of the companies in question. So they're willing to pay a higher price for their shares. Reversely, if a forward PE ratio is lower than a historic average, investors must be relatively full of pessimism and not expect much growth in company earnings, and resultingly are not willing to pay as much for their shares. And I think that perfectly explains the current valuations of US and UK stocks. Investors are seeing better opportunities in the US. They believe American companies are going to significantly grow their earnings in the coming years and are willing to pay a premium for their shares. Whereas investors looking at UK companies see a lot of economic headwind and no clear reason to expect significant earnings growth. Thus, they're only willing to pay less than what they have historically paid. So if you're a contrarian and think that UK stocks are looking too cheap and believe there's reasons to be optimistic about UK company earnings, you may see the current cheap valuation of UK stocks as a great buying opportunity. However, there is another clear reason why UK stocks are out of favour, and that leads me nicely onto the next section of this video, the holdings and sector breakdown. I'll put on screen now the top 5 FTSE 100 stocks alongside the top 5 S&P 500 stocks and their individual forward PE ratios, and you'll immediately see the clear difference in valuations. But also, ask yourself, what do we actually have here? Well, on the UK side, we have AstraZeneca, a pharmaceutical company, Shell and BP, which are oil companies, HSBC, which is a bank, and Unilever, which sells consumer staples. Whereas on the US side, we have 5 of the magnificent 7 tech companies that dominate our daily lives. Given the scale of these tech companies, and that 2023 was the year of AI hype, it becomes pretty obvious why these US companies have higher forward PE ratios. Of course, at a time when everyone is anticipating the rollout of AI, investors are expecting more of the US tech giants than the large UK defensive and cyclical companies. What I hope this top 5 holdings comparison has shown is that you need to put valuations into context. Whilst you may think this is just 10 companies and they do not give an accurate representation of their respective indexes, these 5 UK stocks actually make up 32% of the FTSE 100. And these 5 US stocks make up 25% of the S&P 500, so they are all significant components of their indexes. In regards to the S&P 500, some may say that if we removed the tech giants, it would not actually look expensive. And whilst that certainly has some merit, that is not the focus of this video, and I'm comparing the indexes as a whole. The sector breakdown of these indexes builds upon what we observed in the top 5 holdings, and makes the differences between UK and US stocks even starker. In the US, the S&P 500 has information technology as its largest sector by weight, at just short of 30%, followed by healthcare and financials. And it's also worth noting that the communications sector includes the likes Of Alphabet and Meta, which many people would consider tech stocks. So you could argue the tech weighting is actually even greater than stated here. On the other hand, the FTSE 100's largest sector is financials, followed by consumer staples, industrials, healthcare and energy. Technology is almost nowhere to be seen, with a weighting of only 1%. And I think this breakdown really highlights one of the main problems with the FTSE 100. It is dominated by cyclical and defensive sectors that are unlikely to keep up with the earnings growth achieved by the tech-driven S&P 500. However, I do think there is a genuine danger of oversimplifying things here, and rushing to the conclusion that this tech absence makes the FTSE 100 a bad investment. Tech companies might be able to grow their earnings faster, but if all that growth is already priced in, then there's not much to gain for people buying the stocks now. Whereas UK companies may operate in sectors with less growth, but if they're cheap and growth is not sufficiently priced in, well then they may offer shareholders better returns in the near term. Like all things, I think it depends on how you see it. Will you get higher returns from the expensive looking but tech dominated S&P 500 or the cheap looking but tech absent FTSE 100? I think it is possible to make a sensible case for both answers there, depending on the time period looked at. So from a holdings and sector breakdown, the UK is undeniably the more boring index. But in this next section of the video, I'm going to have a look at one aspect in which the FTSE 100 is the clear winner, and that is dividends. The FTSE 100 is full of great dividend payers with exceptional track records of growing or maintaining their dividend payments to shareholders. It is worth remembering that your total return from investing is the sum of the increase in the value of your shares plus any dividends received. So dividends should definitely not be overlooked by investors. To see what sort of dividend yields the FTSE 100 and the S&P 500 are offering shareholders at the moment, I looked at the relevant iShares ETFs. And from them, I can see that investors in a FTSE 100 ETF are currently benefiting from a 3.9% dividend yield, whereas those in an S&P 500 ETF are only receiving a yield of 1.23%. So although the S&P 500 has offered much better returns overall, you can see why UK stocks are attractive for dividend investors and those looking to take an income from their investments. The psychological advantage of receiving dividends cannot be understated, and some investors may find it easier to keep disciplined by focusing on dividends and seeing nice cash payments land in their investment account. There is a danger in getting a bit obsessed with dividends though, and that is you may lose sight of the real objective of most people when investing, and that is maximising returns. To visualise how these dividends have certainly not been enough to offset the poor returns of the FTSE 100 index, I'll turn to the website Just ETF. And on this chart, I'm comparing the iShares FTSE 100 ETF to the iShares S&P 500 ETF, including dividends. And you can see how the difference between them remains considerable. It's not even close. When it comes to dividends, you have to remember that if a company is paying out cash to you, they have less cash themselves to reinvest back into the business and grow. And in the case of the tech companies in the US, you can see why investors would prefer these companies to keep the cash and use the retained earnings to develop new technologies and keep on growing. Whereas in the UK, as the FTSE 100 is dominated by mature companies that may struggle to generate a significant return on retained earnings, it can make more sense for them to pay out a dividend. So to sum up this point, whilst the dividend yield of the FTSE 100 may well make UK stocks look attractive, always keep in mind that for one, dividends are not guaranteed, but also, if your goal is to maximise your investment return, you should not really care whether those returns come from, whether that be share price appreciation or dividends. I've looked at valuations, how the indexes break down and dividend payments, but the final topic I want to cover is the impact of inflation and interest rate news on the performance of UK and US stocks. After a seemingly long period of high inflation, in the past few months we have had good inflation data come out of both the UK and the US. In December, we found out the CPI inflation rate for the year to November, and that came in at 3.9% for the UK, and when plotted on a bar chart, it is clear that inflation has significantly decreased in recent months. Over in the US, as of making this video, the inflation data is out for the year to December, and we can see that although it is higher than the November figure, the inflation rate is still relatively low compared to where it was at the start of the year. And unlike the UK, where the CPI inflation rate has only recently started to come down, the US CPI rate has been looking relatively good for a while now. A falling inflation rate is good news for stocks because falling inflation increases the likelihood of interest rates being cut, and interest rate cuts are good for stock market returns because lower borrowing costs will help boost economic activity, which should then therefore lead to an increase in company earnings. But also, when interest rates come down, savings accounts, money market funds and bonds start looking less attractive to investors, and they start pulling money out of those and piling the money into the stock market. And of course, more buyers of stocks means the share prices are pushed upwards. In order to show the impact that falling inflation rates can have on stock market returns, I'll turn back to the index performance charts. And we can see on the FTSE 100 chart from the end of October to the end of December, the FTSE 100 was up by over 6%, and this was mostly due to the 2 consecutive months of good inflation data for October and November that came out. Regarding the FTSE 100, I do want to point out that both the US and the UK CPI releases will impact its performance, because the constituents of the index, although listed in the UK, are global businesses that actually make the majority of their income overseas. If you want to invest in an index that responds to UK CPI specifically, you're probably better off investing in the FTSE 250 index of mid-cap UK stocks, which make a higher proportion of their income domestically. And that index saw gains of over 17% in that period. Looking at the same period on the S&P 500 chart, we can see that the S&P 500 was up nearly 16%. So yet again, the responsiveness of the stock market to positive inflation data is clear. I think the key takeaway from this section is that if you think there's more good news to come regarding inflation and interest rates, you're better off getting money into the market sooner rather than later, as by the time any data comes out, you've already missed out on a lot of the gains. Rate cuts are looking likely to go ahead in both the US and the UK, but the extent to which is definitely uncertain. And it's also impossible to know the future, and there's nothing stopping a second spike in inflation from happening. Some may say that the S&P 500 is looking like the safer bet due to inflation being around 3% for a few months now in the US, and the document from the FOMC meeting in December clearly shows that most participants are leaning towards rate cuts in 2024. On the other hand, UK CPI has only dipped below 4% recently, and the Bank of England are giving no hints of any interest rate cuts. Although the markets are certainly expecting at least a few cuts in 2024, and there are some optimistic forecasts that inflation will fall below 2% by spring. So it would make little sense to keep rates so high if that ends up being the case. Given the cheaper valuation of UK stocks, it could be argued that there's more room for them to climb in response to good news, so that is definitely worth considering. Although, given the responsiveness of the FTSE 250, I'd be more inclined to invest in an ETF tracking that index rather than the FTSE 100. So I hope all these points have at least given you something to think about and possibly helped you make your own decision as to whether you should invest in UK stocks. If you're a contrarian, I can certainly see how a good case can be made for investing in UK stocks in 2024. They're looking cheap compared to their historic average, and this cheap valuation may more than make up for the relatively boring sector breakdown. UK stocks are certainly appealing as ever if you're a dividend investor, of course, and these nice dividend payments may well help you remain committed whilst waiting for a possible share price surge.